Okay, very good. So we're recording now. And the first thing I want to do is open up with a poll. And the reason for that is to just get to know you, know who it is that I'm speaking with. It helps me not only to guide this particular class, but also to plan future classes. Okay, so wanted to know how y'all found out about me and what your relationship is right now with power options and/or radioactive trading. Okay, good. We're getting a lot of participation. I appreciate that. Uh, we're going to do a number of polls, but I'm going to try and keep them short. Okay, so I'll ask you guys to be really nimble with your mouses, with your mice, with be real nimble with your fingers here and do these votes quick. Okay, so that we can get to the next segment each time. Okay, so this is less than a minute. I'm going to go ahead and close the poll now. We've got more than half the room have already participated. So let me give it 3, 2, 1. Okay, still less than a minute. All right, so only 1 in 5. We've got 20% are Power Option subscribers. At the end of today's class, whether you decide you want to invest in my product, the Blueprint, okay, or the Home Study Kit, whether or not you decide to invest in that, I am going to give you 2 free weeks of Power Options if you're not already a subscriber, okay? And for those of you that are already subscribers, but you haven't picked up the Blueprint or the Home Study Kit, I've got a surprise for you, okay? So very good. 20%. This is my first radioactive trading webinar. Marvelous. I think you're going to really get something out of this, but we'll find out. What I like to do is kind of a baseline poll. We'll do a little baseline, see how your performance was last year. Then I'm going to show you a couple of tips and tricks, and then you can tell me if it would have helped you. You can tell me if it would have made the picture of last year's trading look different. Okay. All right. 47% are my repeat offenders. Welcome back. I'm glad to have you. 47% been to other radioactive trading webinars, and you're back because you like it, because you're learning something. We have 7% thinking of buying the Blueprint or Home Study Kit. We have 47% have recently bought the Blueprint or Home Study Kit. So that must be where the other attendees are coming from. So marvelous. Guys, this is probably not the forum for you to pose a question about a particular trade that you're in right now or that you're thinking of getting in. That would be for support at radioactivetrading.com if you own the Blueprint or the Home Study Kit. But today I'm going to be sharing the Money Net income method number 5. Be talking about bulletproofing, and we'll be talking about the radioactive profit machine. So they give you a preview of what we're into. Okay. All right. Good. Now I just need to know: do you all see my screen again? Do you see my smiling face? Thanks for participating. I appreciate you participating in the polls and also with these prompts. Okay. So Carl sees me. Okay. Good. Let me go ahead and get us rolling. Okay. Whenever I'm looking at a product, or I'm looking at a method or an idea or just a class like today is, okay, today is going to give you some usable actual tips, okay? It's not just an hour-long commercial. But when I'm watching one of these presentations, I think to myself, first off, so that I don't waste any of my time, is this for me? Is this something that necessarily I am interested in? Okay, and so first off, I'll just get that out of the way. Let's find out if you have had losses in the past. For example, if in the last 12 months you incurred a loss at any time of greater than 5% of what you had in any one trade, well, I can help with that. Okay, so if you're interested in protecting yourself from loss when you pick wrong, then yeah. This is a good class for you. Okay, number 2, how to take income from stocks. Many of you do covered calls, and sometimes I do a poll with that. I don't think we have time today for a poll with that. Sometimes I'll poll and say, hey, what kinds of trading do you do? And usually there's a really big contingent of folks that do covered calls. Well, there's actually, that I've discovered so far anyway, there's actually 12 different ways to take income out of a stock that you own without necessarily selling it. And yeah, dividends is another way. So you got covered calls, you got dividends, but what are the other 10? Well, I'm going to show you one of the other 10 today. Okay, so if you're interested in that, then this is for you. If you're interested in how to participate in growth, this is for you. For example, some folks that do covered calls will cap their upside. Okay. Generally speaking, when you sell covered calls, you sell one call per 100 shares of stock. And if you do that, if you sell one call per 100 shares of stock, you put a limit on how much you can make if that stock suddenly jumps up. Okay. And so if you'd like to participate in growth rather than just capping your upside, yeah, this is for you. Okay. All right. And finally, if you happen to own stock and want to keep owning it, but you're also a little bit concerned about what may happen in the near term or the medium term, if the market itself may crash, then this is definitely for you. I like to use the example of Apple. Apple Computer, now it's called something else. I think it's just Apple Products or something. I don't know. It used to be called Apple Computer, but AAPL. In 2008, Apple had an increase of over its previous year of $3.5 billion in profits, not sales, profits. They started out that year with $88 a share. I'm sorry, with $200 a share, and ended up that year with $88 a share. So Apple was very good at making money for itself, but it was not very good for making money for its shareholders. And the reason for that is that the market is rampant chaos. Okay, so if you have a quote unquote good stock, well, I can't think of a better stock to be in than Apple over the last several years. But even mighty Apple, started out the year at 200, ended up at 88, in 2008, and so therefore it had a 56% devaluation. If you're ready for a 56% devaluation, and you think you can weather that, that's fine if you're going to stay in your stock for a long time. But we have an alternative. We have a way to keep your losses down to 5% or less. So even if you decide to keep your stock. So kind of cool. The Blueprint is my book, and I am going to be talking about it. Okay, it will help you reduce your losses to 5% or less in any one trade, regardless of what your stock does. And that's my big claim. But it's not a secret. In fact, you don't have to own the Blueprint for me to show you how this is done. I'm going to show you today. All right, so it will be actionable, tradable advice, and well, I should be careful with the use of that word advice. Yeah, I'm going to show you a technique that if you grasp it and don't shoot yourself in the foot, if you do it correctly, you will protect yourself and still leave your upside open. Okay. Now today we're going to also be sharing income method number 5. Income method number 5 is nicknamed the money net, and it's a riskless spread trade. Now, that's a big claim. Okay, so for those of you that trade spread trades, those of you that do bull put spreads and bear call spreads and ratio call spreads and time spreads and so on, those of you that participate in that know that most of the time, most often, a spread trade comes along with risk, right? Okay, but I'm going to share with you a way to do a spread trade that has zero risk. Okay, and I'll stand back to that claim. All right, it's a riskless spread trade that creates income, but doesn't necessarily limit your upside growth potential. And for that reason, I think you should be really excited. Okay, so you'll be able to say goodbye to the fear of pain and losses if you embrace this system that I'm going to be sharing a little bit of with you today, and say hello to trading confidently with a winning system, even if you stink at picking stocks. One of the years that I traded publicly, I'm no longer trading publicly. I've got nothing more to prove, okay? But for a number of years, I was trading my account and letting folks look over my shoulder and ask me any question. One of those years, I picked 54% losers, 54% losing stocks, but I still ended up ahead of the game, even with, only 46% wins. All right. And the reason for that is not losing too much when I'm wrong. Okay. So if you stink at picking stocks, well, welcome to the club. All right. I've done pretty poorly in some years myself, but even if you stink at picking stocks, you can still do well. Even if you can't read charts, if you're not one of these gurus, that can, it's going to have a price point here of 131 and then it's going to go down and then it should trade sideways for a while. If you're not that guy, great. Neither am I. I am not that guy. I can't predict what's going to happen next with any degree of accuracy. What I can do is insulate myself against loss if what I expect doesn't happen. Okay, and that's really my big claim to fame. Even if there's a catastrophe, even if the market tanks. For example, my mother gave me a call on May 6th, 2010. She said, "Honey, oh my gosh, I hear that there's something going on in the stock market, and I know that you do something with that. Are you okay?" And I said, "What's going on, Mom?" She said, "The Dow just fell 1,000 points in 15 minutes. That was the flash crash of 2010." And I said, "Mom, I'm going back to sleep. I was in the middle of a nap. Love you. I'll call you later." And true story. The thing is, I was sitting on stocks, but there was no way I was going to possibly be able to take a loss of more than like 1 or 2% in some of my stocks, and Bulletproof in others. And I'll be sharing with you Bulletproofing later on. And I think it sounds too good to be true. And in truth, not every stock is bulletproofable. Okay, but if you're sitting on a stock that's bulletproof, or you have stocks that can't lose you any more than 5%, you can catch a few more Z's. This is the polar opposite of day trading. I don't day trade. I do the opposite of day trading. Okay. All right. Now I see that hands are being raised, and guys, you know what? If you want to, just go ahead and plug your question in. This is a live class. For those of you that are wondering, it's a live class, unless, of course, you are seeing the recording that's later on. Okay. Today is, what is it? It's May 14th, Thursday, May 14th. It's about noon 15. It's 12:15. It was 12:13, 12:14 now. Okay. On the East Coast, it's 10:14 where I am. And so if you want to start posing questions, go right ahead. Okay. There's no sound. There's no sound, says Shy. Okay, guys, listen. Can everybody else hear me? Can you hear me all right? Got piles of you on here. I have sound, says Dennis, Richard, Arnie, George. Good. Okay. All right. I don't know what to say to Shy here. Okay, good. I'm glad everybody else hears me. All right. So sorry about that, Shy. Don't know what to say. I can't say anything that you will hear. Okay. And all right. So listen, in trading stocks and options, okay, what's the problem? What is the problem? The problem is losses. Okay. And sometimes, I used to feel like Charlie Brown. I would sit on a stock and she would go down. I would buy a stock and it would go up, and I'd set a trailing stop loss order. You know what would happen? That stock would dip down to my stop loss. I'd get filled, and then the stock would go on without me. Oh my gosh. Okay, so not cool. I haven't traded stop orders in probably 14 years now. Don't use stops anymore. I use something much more reliable. Okay, but losses is the problem, isn't it? Okay, not making enough when we're right is also a problem. Okay, but more importantly, losing too much when we're wrong. Losing too much when we're wrong is the necessary evil. You have to face it sometimes, losses, all right? But losing too much when you lose, that's the problem. Not losing itself, but losing too much. I teach martial arts. I'm a black belt. I have a martial arts studio that's been in operation actually for 29 years now. And the very first thing that we teach is how to keep your hands up. Okay, that's the very first thing, because guess what? You will take punches. All right, but how you take those punches and how you recover from those punches is what makes you a good fighter. All right, it's the same thing in the market. You are going to risk loss, but does it have to be big? No, it doesn't. So rule number one, don't lose. Even Warren Buffett, the guy that made up rule number one, all right, even Warren Buffett has taken some losses, but he's been very smart about how much of a loss he'll take. Okay? All right. Not me. I wasn't that smart. I'll give you just a tiny bit of my story. Okay? Tiny bit. Okay? Back in 1999, I got involved in a stock trading course called Zero to Zillions. And it was a fellow named Wade Cook that was running that class. And it was $3,000 a seat if you wanted to attend the seminar. They didn't have recordings. You could take notes and so forth. But what they did do is they allowed you to attend other seminars for free if you're a graduate of the first seminar. Okay, but of course at those seminars they'd also sell you more stuff. Okay, so anyway, I got involved in that back in 1999, and I bought stocks. I sold calls against. I got called out. I made all kinds of profits. I did really, really well, but nobody talked to me about addressing the problem of risk. And one of the things that I did was I bought Lipo, Lipo. Now that sounds like liposuction, but it was actually a pharmaceutical company that was based on delivering an anti-cancer drug by way of a person's fat cells. And don't ask me how it worked. I don't know. And these guys got absorbed. They got absorbed by, I think, Bristol Myers Squibb or Johnson & Johnson or one of the big players. Okay. But I bought into Lipo at $17 a share, and I sold the $20 calls against it and was able to get $3 premium. So if I get called out, I get $3 profit on the stock, $17 to 20 profit on the stock, and the $3 premium. Okay. And I thought, wow, this is awesome. I'm going to kick butt. That's going to be a $23 sale on a $17 investment. So that's 30% that I'll make in 6 weeks. Well, some of you that have done cover calls are probably shaking your heads, okay? And guess what? Yeah, I thought I was a genius, but what happened was I got hurt really, really badly. Okay, got hurt really, really badly. I happened to be margined in that. Okay, so the weekend seminar that was supposed to educate me and all the supporting tools and so forth did nothing to keep me out of trouble. And even by following directions, one of the things that Wade Cook said was you need to trade on margin in order to do well, and you should buy stocks that are priced between $5 and $20 a share, and you should sell calls that are a month or 6 weeks out. And so I did that, but I got into trouble. I got into big trouble. Okay, and had to start over. But one of the things I did, like any good martial artist should, I took a look at the fight tape. I said, okay, now where did you make your mistake, and what could you have done better? And almost by accident, I discovered a loss prevention tool that if I had applied it then, it would have worked out. You see, that stock came back. It came back more than full strength. It gapped down 50%, okay, and I had bought on margin, so I got a margin call, meaning that I got cleaned out, okay? All right, but the point is that stock went back up to full strength within the next 4 months. In fact, it went even higher, adding insult to injury. And thing is if I had simply been practicing what I'm going to show you today, I would have made money on that deal, even with it cutting in half like that, okay? Even with that big devastating move, okay? So now I'm not a gambler. Now I don't do silly things like buying on margin and leveraging myself to impossible ends, all right? I embrace this fact that the big problem that got me into trouble was my own behavior, but more importantly, how to reverse that behavior and come up with some practical strategies so that I can make it into a cookie cutter approach, do it every time. And not only that, teach it to others, okay? I became a winner in the stock market, but it's not about me, is it? Okay, you probably want to know if I can help you with your success. So what we're going to do is we're going to do a before-after picture. Here's the before picture, okay? The before picture is, hey, what statement best describes your performance in the market over the last 12 months? Which of these following statements describes your performance over the last 12 months? Okay, now I put the poll up there. I'm not sure. Well, I guess everybody's taking a moment to read through it. I'm going to take a sip of my coffee here. Yep, now we've got folks coming in. Okay, good. Very nice. All right. So 26% of the room has voted. Now 32, now 36, now 38% of the room has voted. Now it's over 40. I know that some of you are calling in or may have restriction to how much you can participate because of where you are at work or whatever. But for the most part, I expect that we're going to be able to get a good reading here with over 50 responses. Okay, let me go ahead and close that poll because it's 1 minute, and I told you I was going to keep these short. Okay, 1 minute and close. All right. So let me go ahead and share this. 31% say I picked more winners than losers and won last year. Good. Okay, super. 15% I picked more losers than winners and I lost last year. Not as good. Okay, sorry about that, guys. Now, here's something that concerns me greatly. 27% picked more winners than losers. You were right more often than you were wrong and still managed to lose money. Well, how does that happen? I'll tell you how that happens. One of the ways is with a simple covered call play. Let's say you invest in 10 stocks, 7 of them go up, and you get called out. That's marvelous. Okay, and you make your 3%. And then 2 of the stocks that you picked go down by 10%, and it wipes out everything else. Okay, and one of your stocks stays flat. And so that's how that can happen. You can be right more often than wrong, but still lose money. Okay, 19% say this. This is interesting. I picked more losers than winners and still made money. Now that's what I want to know about. Okay, I've actually experienced that myself. I was, for those of you who came in late, I was saying earlier that I'm a lousy stock picker. Okay, and in fact, one year that I was trading publicly and having folks look over my shoulder, I picked 54 losers and 46 winners. Okay, and but the point is this: I still made money. Okay, and so did these guys. So good for them. All right, and then 8% say I'm ready to quit just to stop the hemorrhaging. Okay, now that's our baseline, and I'm going to expect that the same 50 of you that are participating, okay, that the same guys are going to participate again when I say, okay, now that I'm showing you this technique, are you going to do better off, or would you have done better off last year? Okay, if you had known this technique at the beginning of the year. Okay, all right. So here's the deal. Why hasn't the problem been solved yet? Well, I'm going to go through this really fast. These are some of the reasons that folks lose at trading. One is that they just trade by the seat of their pants. Okay, gut instinct. And that's also the way some folks fight, and I've been a fight trainer for a number of decades. I've been full contact fighter and trained people for the mixed martial arts cage. And I'll tell you what, okay, just flying by the seat of your pants is a recipe for failure. Okay, how about this? How about exit rules? Everybody likes to play with different systems. I think I've got a system. Okay, and you know what? A lot of times those systems are good, but they only address picking stocks or timing trades. The system doesn't by itself address risk. Oh, okay. So a lot of times those systems can betray you. What about stop orders? Well, a stop order to me, I haven't used one in over 14 years. Okay, a stop order to me is simply you telling the market maker, hey, if it looks like things are going bad, go ahead and just give me whatever price you think is fair. and that's really what it is. I used to joke before, when I still used stop orders, I used to joke that I had a way of predicting the future. And my way of predicting the future was, okay, I'll set a stop. And what I just did was I predicted the low of the stock for the day. the market would come down to that. I'd get called away, right? That stock would get called away from me. And then the stock would go right back up without me. Okay, you can't tell me there's some kind of manipulation. There is some kind of manipulation going on in the market. But point is this: I don't participate in stop orders anymore. And the thing is, what I just talked about, if you've been trading with stop orders, you know about it. Okay, but here's something that's even worse: stop in stop order does not mean stop at this price and sell. It means stop and sell at any price now that the order has been triggered. And here's a true story here. We have Daktronics. Daktronics had an overnight gap of over 35%. Well, if you had been trading this with a stop loss order, you would have gotten out with an over 30% loss, right? Okay, but in fact, I was in this play and only had an overnight loss of about 4%. So it's regardless of what the stock does. What I'm going to share with you will keep you out of trouble. Okay. Now, fundamental analysis. Fundamental analysis is the way that Warren Buffett has made his millions. Now, he has made those millions, actually I should say billions, over a course of 6 decades. Okay, so he's done a lot of investing. All right, but it assumes two things. Number one, that you are smarter than the rest of the market. Okay, and then number two, that at one point or another, the rest of the market will catch up to you and they'll be as smart as you are now. Right? And those are two very big assumptions. Number one, hey, I'm smarter than the market. Number two, okay, maybe that thing is underpriced, but when is everybody else going to realize it's underpriced or overpriced, if you short? Okay? All right. Technical analysis, again, is the bold assumption that the past will tell you what the future holds. And you know what? If it were accurate, there wouldn't be a market. This is an arena for people, for one party to transfer risk to another party. All right. And if there's no risk, well, then there wouldn't be a market. Okay. So what I'm showing here is actually a snapshot of how the market was during oh gosh, I want to say it's 2007, during a particular time where XL Maritime Carriers was like way up and way down. It was a very turbulent market. But I happened to be investing in this with only 5% risk. What happened was in a 6-week period, I made 10.22%, and I cashed out on 10/22. And 10/22, October 22nd, also happens to be my birthday. So guess what? It was a wonderful birthday present to make double digits in 6 weeks. But what's impressive about this trade is not that I made over 10% in 6 weeks. It's the fact that for the first 3 weeks, I had only 5% of my capital at risk. And for the next 3 weeks, I had less than zero at risk. I had no risk. It's what we call bulletproof. And I'll be sharing that with you, how that's done. Okay. Now, diversification is taught as a money management method. But the fact is, if you're diverse enough, all right, what that means is you've just got a lot of things to manage. And so if there's a market-wide crash, you're in trouble. All right. So finally, insider information. If you think that knowing a thing or two about what's going on behind the scenes is going to be helpful, well, it might put you behind the scenes, if you know what I mean. All right. So I wouldn't encourage insider trading. Okay. So is the key to winning plays picking stocks? I'm going to have to say no. Okay. Is the key timing trades? I'm going to say no again. I think it's something completely different. But strangely, that's where everyone looks for the answers. And while it is important to have some kind of criteria when it comes to picking stocks, and while entry signals are important, I'd say that those two things make up about 10% or less of what goes into a successful trade. What's more important is this: understanding gambler's ruin and knowing how to reverse it. So let me show you gambler's ruin, okay? The math that goes behind how people are getting ruined, and it'll tell us how we're going to get it right, okay? All right, so the martingale, also called gambler's ruin, is a principle that shows how there's an even more desperate move every time we have a loss, okay? And I've personified, or I've monsterified the martingale here. He's chewing up bags of money, and he's got dollar bills for scales, okay, or dollar signs for scales. And the martingale works like this, okay? Let's say that you begin with $10,000 and you suffer a 20% loss. Now, a 20% gain after that is not going to bring you to break even, is it? A 20% gain after 20% loss looks like this. Here we have the 20% loss. We start with 10,000. Now we have 8,000, right? 20% of 10,000 is $2,000. But then when we take our $8,000 and we play it for 20% gain, well, that's only $1,600 of profit. So now we are at $9,600. So a 20% loss plus a 20% gain does not equal ground zero, okay? It equals, hey, I'm down by 4%, not counting commissions, okay? Here's what really works. If you have a 20% loss, you need to offset it with a 25% gain. And of course, what this does is this encourages the investor to risk more and more of the portion of capital that they have. They risk more and more of the portion of capital that they have until they're finally cleaned out. That's what happens with the martingale principle. And whether you realize it's going on in your account or not, it's fairly insidious, okay? It pokes its ugly head up all the time. Now, the thing about the Martingale Curve is that while your losses might progress linearly, your amount that you need to recover progresses geometrically, okay, or exponentially. It's an exponential curve. Now let me clear all this stuff out in between, and I want to ask you something here. We're going to do a quiz here, okay, and just see if everybody's paying attention and if everybody can do math. Okay, all right, here's the deal. If 50% loss, whoops, where are we? Sorry, I got to go back one. There we are. If a 50% loss takes a 100% gain to break even, what does the 5% loss need? Well, it doesn't need a 10% gain to break even. Okay, 50% loss, 100% gain to break even versus a 5% loss. It doesn't need a 10% gain. It needs a 5.26% gain. Okay, all right. Now, here's what I'm going to do. I'm going to ask you guys a quiz here. What if you were able to, with options, for example, double your money when you're right, but not take a full loss when you're wrong? Okay, double your money when you're right, but not take a full loss when you're wrong. What could happen? Let's say that you lose 50% when you're wrong, but you gain 100% when you're right. Okay, but you're wrong more often than you're right. Okay, does this sound to you like a good play? All right, now I want you to think about it real quick. If you have a 100% gain, that means doubling your money. So you start with $10,000, you double your money. Guess what? You have $20,000. But along comes a loss, and your $20,000 isn't completely lost. You only lose 50%, but 50% of 20,000 is what? 10,000. So you have $10,000, you have one win, one loss, you end up where you started. What if you have more losses than wins? Could you win this game? Could you win this game if you had more losses than wins? Okay, so let me go ahead and allow those results to tabulate. Oh, it's actually been up more than a minute. Huh. But you know what? Some folks are still doing math because it's still populating. Okay, all right. I'll let it go here for a second while I do something here on my screen that you can't see. Okay, probably lost 60%. Okay, good. All right, let me go ahead and close that poll. And I'm going to share the results with everybody real quick. You know what? 36% said, yeah, you could win at this. It's worth betting on a good income. You just need money. All right. Now that's a minority. Not a lot of people thought that. 23% said, it could happen. You could win with this, but it's unlikely. 60% probability of loss stacks the deck against you. Okay. And then 41% say, no way. No way. The 50% losses offset the 100% gains, plus you lose too often. Okay, all right, so about 2/3 of the room says, no, this is not a winning strategy, and about 1/3 of the room says, yeah, this is a winning strategy. Okay, let me show you how this really plays out. Okay, this is radioactivetrain.com, and one of our tools here is called the Trade Simulator tool. It's on the Resources tab, the Trade Simulator tool, and I encourage you to use this and maybe plug in the values of what your average return has been, what your average loss has been, and how often you've been right or wrong, and see how that's going to play out over time. Okay, all right. So here's the deal: if we lose. Oh, you know what? I did this wrong. Target return should be 100%. There we go, 100%. Loss limit 50%. Okay. All right. Now, we've got a probability of a loss of 60%. But guess what? We're going to do this 100 times. We're starting with $10,000. All right. So, okay, that was bankrupt after a few trades. Oh, there we are. Bankrupt after 28 trades. We started with $10,000 at one point. We're up to $160,000. And we would mistakenly believe that we have a winning trading system. But you know what? When you have a greater probability of a loss, you're going to get in trouble. Let me run it again. Well, this time we're bankrupt after 32 trades. Took $10,000, rolled it up to 80 grand, mistakenly believed we had a winning system, and then shot ourselves in the foot. Same thing again. Same thing again. Okay. Oh, look at this one. This is really interesting. This one had a greater number of wins, and so because of that, the $10,000 went to $20 million. But it also went down to $625 by the end. All right. Now, here's what I'm going to do. I'm just going to change one thing about this. And I'm just going to say we're going to only risk 10% of our capital in each play. And by doing that, now, even with losses outnumbering wins, we've got a winning system. Okay, even with losses, even starting off with, look at this. This is 63 losses, starting off with a string of losers. Okay, but having a smattering of wins here and there. Okay, and we take $10,000 and we turn into 13,400. Okay, 34% gain. Here did even more healthy. Again, 58 losses out of 100. And yet took her $10,000 and rolled it up to nearly 30 grand. Okay. All right. So the reason for this is that we started off with something that the martingale would love, but then we shot the martingale in the back by only risking a portion at a time. And that is essentially, guys, how this works. Okay. All right. So by showing you the math, I think it's really important to show you the math so that you understand, hey, this isn't pie in the sky. But then I'll go ahead and show you the practicals on it. In the example that I just gave, all right, we're losing 50% when we lose, but we make 100% every time we win, and we win less than half the time. If we bet our whole stack, it's a losing proposition. But if we scale it down by 10, so that now we're only losing 5% of our capital when we're wrong and making only 10% when we're right, you could be playing the same stocks and using the same timing, the same entries and exits, but yet compound your winnings. And folks, in case you don't realize it, I just handed you the key to trading. In case you don't realize it. Now, the practical side is important too, okay? But the conceptual here is very, very important to underpin that, to underlie that. Otherwise, whatever techniques you use are not going to be sound, okay? This concept of position sizing is the most important thing you could possibly learn in trading. And I've just given it to you, and I hope that it makes a dent, okay? All right, this is called skew, and mastering skew is the first goal to trading successfully. You got to skew yourself, because if you don't, you will screw yourself, okay? All right, good. Now, let's go into the segment where I'm going to show you the practicals, okay? The how-tos. This is what I call the radioactive profit machine, or RPM for short, that skews reward over risk. Okay. Now, a quick overview of how we trade goes like this. Let's say that this dotted line is your cost basis for your stock. Your stock could go up or it could go down. Okay. Now, what a lot of folks do when they hedge themselves against a loss, what they'll do is they'll sell a covered call. And what the covered call does is it lowers your cost basis. So, for example, let's say you bought at $50 a share, and you take a $1.50 credit, guess what? That's 3% that you've taken off of the cost basis of your stock. So now instead of costing 50, it's $48.50. Instead of costing $50, it costs you $48.50. Now that's a nice little skew there. We've changed the field a little bit, but you know what we've also changed it by? Instead of, here's a 0, which is where your stock could go theoretically. Now your stock could go to $1.50, right? On the other hand, how much could your stock gain? Well, if we're going to be generous and say 6%, because that's what the gurus say, you're going to make 3 to 6% a year. Okay, I'm sorry, 3 to 6% a month is what they say. If we're going to be generous and say the stock goes up a little bit, and you get to keep your premium, why then now we've painted ourselves in a corner to where we can only make 6%. So that's not good, especially if the stock goes up 10% or 15 or 20% or 100%. All right, we've painted ourselves in the corner, and that is the covered call solution. Okay, now what I'm going to tell you is that you can actually take that thing and flip it upside down. Okay, so that instead of taking just a stock and receiving a credit, we're going to take the stock and we're going to add a little bit to the cost basis. Now that seems counterintuitive. Big word. My son asked me, what's counterintuitive mean? I said, it's a big word. It means doesn't seem right. Okay. So this maybe doesn't seem right. Okay. But what I'm going to do is I'm going to add to the cost basis. So instead of $50, okay, maybe I'm going to spend $52.50 or something like that. I'm going to raise the cost basis by just a few percent. Here's what the result of that is. I'm going to be buying stock insurance. I'm buying a put option that guarantees me that even if the stock goes to 0, I get out at a small, say 5% loss, okay? And yet the upside is still left open, okay? Now, what I've done here is 2 things. Number one, I haven't traded a long call. And the reason for that is this. if you trade a long call, nothing wrong with doing that, okay? But if you trade a long call, the temptation, first of all, is to buy too many contracts because you've got lots of cash on hand and buying calls is cheap, okay? And so there's a temptation to buy a lot of them, okay? Number two, the income methods, of which there are 12, many of them are defunct. Many of them don't work when you only own a long call. And that's why, the two reasons why I choose to buy stock and also buy a put option. Okay, so I know that the question usually comes up, why couldn't you just do this with a long call? Well, there are mathematical reasons. There are legal reasons. Okay, some of the things that I can do to manipulate this position later on, I can't. In certain brokerage accounts in certain countries and under certain laws. Okay, but then I can if I have the stock. All right. So anyway, here we are. We own the stock. We also own a put option. Now, if that stock's volatility signature had been 15%, say it could go up 15% in the next 2 or 3 months, or it could go down 15% in the next 2 or 3 months. Guess what? I'm protected to the downside. If it goes down, I'm not going to lose 15. Okay, I'm going to lose maybe 5. At the same time, to the upside, I'm only subtracting, okay, a little bit. Okay, so if we converted 15 this way and 15 that way, well, that means if I'm right half the time, wrong half the time, I'm going to come out behind because of the martingale, right? Remember, if you have a 20% loss, a 20% gain does not offset it. A 15% loss, a 15% gain does not offset it. But what about a 5% loss? Would a 10% gain offset it? You bet your sweet bippy, my dad used to say. You would do very well to do this. You could actually be wrong more often than right and still make money. So all we've done, we haven't changed what stocks we're picking. We haven't changed our entries and our exits. We've only changed how much we're willing to lose when we're wrong. And we've maybe mitigated a little bit how much we can gain when we're right. But you know what? 10% beats the snot out of 3 to 6. By the way, I would like to do a quick quiz for those of you that have been doing cover calls, and I only mean to poll those folks that have done it for 24 months or more running. Okay, so if you got out of the seminar 2 weeks ago and you sold a covered call and you got called, and it looks like you'll get called out tomorrow at a profit. Okay, tomorrow's expiration Friday. If you think you're going to get called out tomorrow to profit for 3 to 6%, okay, fine. Okay, don't vote. I only want those guys that have been doing it for 2 years or more continuously to participate in this poll. Have you made 3% per month? Because what that means over 24 months is that you've doubled your money. You can actually not, hey, I've made 3% and next month I lost 6. It's, look, did you double your money in 24 months? Because that's 3% per month. Or did you quadruple your money? Because that's 6% per month. All right. So only the folks that have done it for 24 months or more consecutively at any point in their career, it could have been 10 years ago and you abandoned it. Okay, that's fine. But I'd like to know what your record was. Okay. Did you make double? Did you make quadruple? Did you get ahead but not like what they promised? They said 3 to 6% per month. Okay. Are you about flat or are you actually losing money? I want an explanation. Oh, how about that? Look, it says I'm losing money. I'm losing money, honey. All right, it should say losing money. I'm not sure why that. It's probably my fault. Okay, so let's leave that poll up for another few seconds. We've got 20% of folks in the room. 22% of folks in the room have voted. Okay. All right. Now, all right. Now I've got a challenge here. I have a challenge to make. Okay. So let me go ahead and close this poll in 3, 2, 1, and close. Okay. Now, first off, let me explain the numbers here. 28% of 55 people is how much? We've got 55 people in the room. 28% of 55 people is not a lot. Only 28% could vote. I'm getting out my calculator. 55 times, times 0.28 equals, okay, so we've had 15% cast their vote. 15 people, sorry, 15 people cast their vote, and 7% of 15 people is one human. Okay, all right, so I just wanted to be real specific. We got one human claiming. Now, I'm not going to call anybody a liar, okay? But I am saying that you're claiming to have quadrupled your money using covered calls. Okay, now, I've done this twice a week for 7 years. So that's over 700 polls. And I've had a small handful of people make this claim. Some folks have said 3% per month. You know what? I can buy that. I can believe that when it's the right conditions. And some other folks, just like a handful through the years have said 6%. They've made 6% a month every month. They've made their quadruple. I'm going to invite you, please, to send me your trading record because as yet, no one has accepted the invitation. Actually, I shouldn't say that. One fellow did accept the invitation. He sent it to him, and he says, "See, I made 6% a month." I said, "No, you didn't." He started with like 150 grand, and he ended up with like 200 grand. And I said, "The thing is, dude, it's what you can liquidate it for today, not how many times you've collected premium." Okay, all right. So anyway, so we're going to deal with the minority here. The one fella, you know what? It could happen. All right, it could happen. But I've never had anybody share with me and show. So I'm not calling you a liar, but I really would like to see your record to confirm if indeed you quadrupled your money with covered calls. Now here's what the rest of everybody said. 47% said, well, I'm ahead, but not like what they promised me. Okay, 13% are about flat. After 2 years of trading, you're flat. And in a bull market, I say that's being behind. Okay. And then 27% say, I don't get it. I'm losing money. I want an explanation. Well, the explanation is this. Okay. You've accepted too little on the way up, and you've left yourself open to disaster on the way down. And on Tuesday, the recording is probably still up. If you get a chance, those of you that want the explanation, I did an expose on covered calls on Tuesday, and I showed why it is that the majority of people that play covered calls end up behind. The majority end up behind. Okay? All right, so let me go ahead and move on here. I'm going to go ahead and show you the practicals of the radioactive profit machine. Okay? All right, so here's the radioactive profit machine, and I'm going to use an example from about a year ago. For current examples, you can become a member. All right, but here it is. Stock price on CAR. That's CAR. Nice, catchy little three-letter acronym for what do you call it? Avis Budget Rentals. Okay, 49.45, and at the same time he picked up a January. Now that's January 2015. Okay, that's far away in time. Okay, it's 10 months. January 55 put for $9.50. Okay, so that's a total expenditure of $58.95, but he's guaranteed to get 55 back at least. Okay, so what's the difference? The difference is $3.95. Okay, so $3.95 is the most that he could possibly lose, or about 6.7%. Okay, and yet the upside is open. Okay, now you'd think that buying a put far away would be too expensive, but it's not. You see, the fact that Mike picked up a put option that was 10 months away does not obligate him to hold for 10 months. He's not buying it so that he can hold for 10 months. Okay, he's buying it because time value gets cheaper and cheaper and cheaper the further per month, the further out you buy it. Okay, here's what I mean. This is the exponential curve. By the way, this is why we call this radioactive trading. It follows the decay curve, actually upside down, but the decay curve of a radioactive element. Okay, in radioactivity, you have something called a half-life, and that means that half of your radioactive substance goes away right away, all right, and then it takes longer for the next half, and takes longer for the next half, and longer for the next half, and so forth, and it just lingers. Okay, well, we're flipping that upside down. What we're going to do here is buy far away in time. Why? Because time values falls off slowly at first. It falls off very slowly. Now, if your intent is only to hold for 30 days, you can still just hold for 30 days. Okay, but you'd still buy a put that's several months away. Here's why. This put that's far away in time only loses a tiny amount of time value for the 30-day period that you hold it, right? On the other hand, if you were to do a traditional married put and buy your put option a month away, look how fast the time value of it decays. Okay, so we're doing married puts, but we're doing it a very different way. We're doing it a smart way. After all, you shop for your insurance when you buy a car or a house or even health or life insurance. You want to get the lowest premium for the best coverage possible. Well, the premium here monthly is very low, even though it's 4 months away. I don't have to hold it for 4 months. I could hold it for just the 1 month and lose this much versus holding it for 1 month and losing that much. All right. So that's why we buy the put far away in time. It's not an obvious hack, but it works. Okay. All right. So to confirm the truth of what I'm saying, all right, I want you to think back to your own record. All right. This is, we did our baseline before. Our baseline was, how did you do last year? So let me go ahead and put that baseline up, and I want the same 50 people that participated to participate again, okay? I said, here it is, okay? This is the old one. What statement best describes your performance over the last 12 months? Okay, I said that. So now I'm going to say, would it be better? And it doesn't, this isn't just limited to folks that did poorly last year. If you did well last year and you think you would have done weller, then let me know. Okay. If you did well if you did poorly last year and you think it would be a game changer, let me know. Okay. And by the way, if you don't think this would make any hoot in a handbasket to you, if it didn't change things for you at all, let me know that too. Okay. Now I haven't shown you the income method yet, but what I have done is shown you a unique way of keeping out of trouble. The income method is probably what you open up the email for, though, right? Didn't I say something about a riskless spread trade? I am going to share that. Okay, so wow, this is pretty one-sided. So far, nobody is saying that they wouldn't have done better. So far, nobody is saying that. So I'm kind of inviting that. I'm kind of saying, hey, look, if you don't think you would have done better, tell me. Okay. Wow. Okay. Let me close it. So make this bigger. Okay. So 60% said yes, this would have made a difference between a losing year and a winning year. Okay, losing and a win. And 40% said I did well last year, but I would have done better. Wow, guys, that's 100% of you that participated anyway in the vote. Okay, 100% of you saying I'd be better off. Well, guess what? What if I asked you the same question last year? I'm sorry, next year. What if I asked you the same question next year? Will you say, yeah, I'm glad that I used this long-term put option idea that Frankenberg was talking about? Okay, I think it's logical. I think it does make sense. Okay, folks, I'm going to go ahead and check in and see if there's any questions. And after that, because I can't be presenting and answering questions at the same time, what I'm going to do is open up the question here. All right. Okay, Rick says you shouldn't make the martingale so pigeon-toed. Okay, Sunil says, what if the stock crashes within the first month of buying the leap put? Well, Sunil, that's a great question. What if the stock crashes within the first month of your buying that leap put? What if? Well, first of all, what I showed with Mike set himself up to where his greatest possible loss is 6.7%. But guess what? That 6.7% loss is not realized for another 10 months. Okay, if he was to hang on to the stock for 10 months and it stayed crashed, it stayed down and it never recovered, then at that point he'd be able to exercise his put and only lose 6.7%. But what if he sold his stock and his put separately? You see, that put still has time value in it. And so in truth, he's not going to lose 6.7%. He's going to probably lose more like 5% or 4% or, much less. So that's why. Okay, I mean, that's what if. Now, if Jill asks a very good question, but let me finish with Sunil here, okay? Sunil says, what if it crashes? And probably you're worried about, losses. Well, Sunil, if you're worried about a 5% loss, okay, or a 6.7% loss, just imagine what it would have been without the put. Okay, if the stock crashes, if it has a 40% drop, Your stop order is not going to help you. Your put option will. Okay. All right. So that's a good what if. All right. Rick says Mike doesn't help on these webinars anymore. Mike does help me now and again, Rick, but he is extremely busy at Power Options. And one of his functions is that he takes radioactive traders like you and me and sets them up on how to search for these kinds of trades. Okay. All right, good. Jill asked, do we need to look for stocks that are more liquid? Yes, Jill, you do. And more importantly, the put options should have liquidity too. And it's not necessarily how many shares are traded per day that's important. What you want to look at is you want to look at the bid-ask spread. If it's more than 20 cents, I wouldn't touch it. I like to, for example, on Starbucks, even a put option a year away might have a tighter spread than that. Okay, so I'll trade stocks and options that will give me the fairest price possible. Good question. Arnie asks, if the stock stays flat, will you lose all your put premium? No, because guess what? Some of that put premium is intrinsic value. So I'm going to rewind for Arnie. Okay, I'm going to rewind just a little bit to this page here. Whoops, wrong way. Here we go. Okay, so Arnie, look at these numbers. Okay, he has spent $950 on his put, but the most that he could possibly lose out of this whole arrangement, put plus stock, is $395. Okay, so no, you don't lose all of your put premium. You lose a portion of it. Okay, if your stock goes way against you and you don't do any income methods. By the way, I should talk about the income methods, because right now, what's so different now? What is different now is skew, and I'm going to explain what kind of difference that makes. Okay, but then we're going to talk about the income method. Skew means that the old trader's maxim of cut your losers short and let your winners run is actually being put to use. So good deal. All right, but here's something that is also very important. We've changed the expectancy of whatever trading system we're already using. Okay? Now, to calculate the expectancy of what you're doing right now, what you want to do is take the average number of your wins, the number of your wins, and multiply that times your average win. Okay? And subtract your number of losses, multiply the average amount of the loss. And it looks like this: number of wins times average win minus number of losses times average loss, and that will equal your expectancy. If that number is less than 1, stop doing what you're doing. Right? If that number is greater than 1, you can expect over the long haul to make money. Now, how can we change the value of this whole equation to the better? Well, there's only one thing that we can do that really makes sense, and that is this: reduce how much your average losses are. If you reduce how much your average losses are, the rest of the equation takes care of itself. Even if you lose more often than you win, but your average losses, which is the only thing you can control anyway, if that is handled, then the rest of it seems to sort itself out. Okay, and guys, I just gave you the key to winning. If you get nothing else from today's class, none of the specifics, none of the setups and so forth, but if you just internalize this, if I keep my average losses low enough, well, the rest of everything is going to take care of itself. Okay, that's really how simple it is. Now I'm going to show you my friend Mike Chupka here. Mike is the fellow that was just being asked about. Okay, who is it? Rick just asked about him. Okay, Mike is my good friend and a fellow trader. Okay, now here's the deal. Mike introduced me and the the owner of Power Options. Okay, now he's the director of options education, and he introduced us. Now he had been impacted by losses by trying all these exotic kinds of plays. Okay, double diagonals and time spreads and a calendar call, bull put spreads, straddles, strangles, all these things. Okay, but in 2008 he decided to start trading radioactively. In 2008 he posted a loss of 1.5%. Now, if you weren't trading in 2008, that may not make a lot of difference to you. You might say, well, so what? But if you were trading in 2008 and you were long stock, you realize that that's a big deal. Okay. The mutual funds, most mutual funds across the board lost about 40% of their value. I opened up today's class talking about Apple. Apple had a bumper year. Apple made lots of money for itself. It just didn't make any money for its shareholders because it started 2008 at $200 a share and ended it at like $88 a share. Okay. 56% loss. Well, Mike posted a 1.5% loss, and then since then, every year double-digit gains. Okay, every year double-digit gains in his radioactive trading account. Okay, he struggled with options at first, but he got control, and now it's 6 years of double-digit gains, and he's on track for the 7th right now. Okay, now here's a testimonial from Mike. My SLW position was 300 shares plus 3 put options. I had only single-digit risk at the beginning. Okay, he had 7% of his capital at risk. But then used an income method and became bulletproof in the first 5 weeks. Okay, so after 5 weeks, he does something to change his play to where now he can't lose. Okay, that's what we call bulletproof. And then he held it for another 4 months. It went on to make 58.9%. Wow, 58.9%. Now, he also picked another stock in the same 12-month period. He picked another stock and he put a similar amount of cash into it. TLM stock lost 50% of its value, but Mike only lost 4.5%. And by the way, that was his biggest loss of the year. Okay, why? Because he's using the RPM setup, radioactive profit machine setup. He buys stock with puts, and he'll also use income methods to mitigate even that risk. And so what happened was I'm showing the most dramatic win of that year, but I'm also showing the most dramatic, devastating, damaging loss that he took in that whole 12-month period was what? 4.5%? Geez, guys, this is trading. This is how it's done. Okay, when you have 50% losses and 100% wins, you would never get ahead, right? But if you have, say, a 4.5% losses and 58.9% wins, you do very well. Now, not every one of Mike's trades was a 58.9% winner, but I'll tell you what, he ended up with a great double-digit gain for that year. All right, why? Because his number of wins times his average win minus his number of losses times his average loss left a positive number. Okay, that was his expectancy. And the only thing that you can control is this number here, average loss. Did he control it? I'll say 4.5% loss being the biggest loss of that year. Huh. All right, so Mike has been able to slay the Martingale, and I want you to invite you to slay the Martingale also. I believe in you. I think that you can do it. Okay. All right, now let's see. Len asks, why don't you use options instead of the stock? Len, I addressed that a little bit earlier. There's a lot of reasons mathematically why you want to buy a stock and a put option rather than just to play pure options plays only. And there's also legal reasons. There's 12 different income methods, of which I'm going to show one. There's 12 different income methods that can be applied here, but some of them can't be applied with a pure options play. Okay, so what else is different now? What was different in the first place was now we've added skew. Would you guys like to see what else is different now? We're at the top of the hour. It's 1 o'clock on the East Coast. I would like to show you this riskless spread trade. I know that some of you need to leave, and if you do, that's fine. I am recording this. We are going to post it and leave it up for a couple of days. But who would like for me to go into it right this second? Okay, would you like for me to show you how to do a riskless spread trade that may pay you twice? Arnie says, yes, please show. Okay, Lenny's into it. Rick is into it. Please now. Jill says, please. Okay, so some folks are saying, hey, enough with the buildup. Let's go. All right, please. We got okay. All right, so here it is. All right, within the context of a radioactive profit machine, okay, we can do what I call nested spread trades or income methods. Income can still be generated 12 different ways. Okay, and I'm going to show you one of them today. That's all I've got. Brian says absolutely. Okay, Brian, I'll absolutely show it to you. This is really cool. We're going to show you a spread trade that can pay you twice. Doesn't always pay you twice, but it can pay you twice. But the really cool part about it is that it has no risk. Okay, the radioactive trading income methods are used to reduce the cost basis of your stock so that it enhances the skew. If, for example, you've got a certain amount of risk and then you reduce that amount of risk by reducing how much your stock ends up costing you, well then you enhance the skew, don't you? Okay, and I'll show you what I mean mathematically. This is it graphically. Let me show you mathematically. Okay, so here's Mike again. He sells to open 2 May $55 call options at $1.50 a piece. So he collects $3 of premium. Now, I want to remind you that Mike is sitting on a stock, and he's also got a put option clear out to January of the following year. Okay, he's got stock, and here in April 21st, he sold these calls against the stock that he owns, and he owns that stock at a cost basis of $49.50, I think it was. Okay, so he's selling the May $55 call options, 2 of them, at $1.50 a piece, or generating $3. Now, here's a problem. Most folks are going to look at this and say there's a problem. The problem is that Mike only has 100 shares. How can he sell 2 calls? If he sells 2 calls, then he's covered on one of those calls, but if the stock goes up, the other call is naked. In other words, he has the obligation to deliver shares at 55, and even if the stock goes to 100, he has to buy it for $100 and deliver it at 55. He's going to take a terrible loss. Well, watch this, okay? Because this is what he also does at the same time. At the exact same time that he sells to open 2 calls, he uses some of the money to buy a May $52.50 call for $2.60. Okay, so the premium generated is $3, and the expenses made are $2.60. So he's made himself a little premium here of 40 cents. Now, that may look to you like it's not very much. You know, after all, I could take $1.50 for just doing a covered call. So you want me to settle for just 40 cents? Well, keep tuned. Okay, keep tuned in, because here's the thing. Oh, by the way, if you did this naked, if you didn't already own the stock, and you simply sold 2 calls and bought 1, you would have risk. Okay, you'd start losing money. Okay, normally. But the fact is, we're doing this in the context of owning the stock, right? Okay, so this is the 2 short calls and 1 long call idea here. And while the stock is, staying below 52.50, we get to keep our 40 cents. But if the stock goes up a bit, hey, look at this. It climbs this ladder, and you might get paid more when you exit. Weird, right? I'm going to show you how that works in a second. Okay. What was the stock at? Asked Rick. Rick, I'm not sure, but I would guarantee that it's close to $55. Okay, you wouldn't be able to pull this off if the stock was trading at 52 or 50. But when it's at $55, this premium swells a bit. Okay, or close to it. It might have been 53, 54, might have been 56. I don't know. Okay, you could look it up. You could look it up. All right, so good question. All right, so here's the deal. When May expiration came, Mike had the option, okay, of getting out at a decent profit or holding his Avis budget rental stock, his car stock. And on expiration Friday, Mike decided that he wanted to keep his car stock. So what do you have to do if you're a covered call seller? You sell a call and the stock closes above your long call. What would you have to do? That's a question I'm asking you guys, okay? Let's say you sell $55 calls and your stock goes to more than $55 and you want to keep your stock. What do you got to do? Okay, yeah, you got to buy it back. You got to end the obligation. You got to buy back that call, sometimes at a loss, okay? Sometimes for more than what you paid, all right, or what you were paid. Buy to close. There we go. All right, we got folks participate now. So here's the thing. Here's what Mike did. He did buy his call options back. But guess what? His 5250 call went up. Why did it go up? Well, the stock went up. Okay. So here's the thing. It's May expiration. It's expiration Friday, like it's going to be tomorrow, right? But this was May expiration last year. So he bought to close the May $55 call options at 15 cents a piece. Why? Well, the stock was at 54.80 when he did this. Later that day, it closed at $55.16 a share. Okay, so he set a limit order. He says, you know what, I want out. And so he's buying to close two May $55 calls for 15 cents a piece, or 30 cents total. But he gets to cash in. Remember, he used the proceeds from these two calls earlier to buy this call, and now it's like he got paid to own this call, right? So he gets a second credit then of $2.05 on expiration Friday. So that's 40 cents to open this trade, $2.05 to close this trade, or a grand total of $2.45 collected. Now, let's compare that against a covered call play. A covered call, remember, you would have received, let's go back, you would have received $1.50, right? But you would have still had to pay out 15 cents to get to keep your stock. So it'd be $1.35 net. Well, Mike nets $2.45 net. Okay, so that's 80% more, a much fatter premium that's collected. Now, what makes this riskless? Well, I'll tell you. The reason that it's riskless is that Mike has stock on hand to deliver. When you have two short calls and only 100 shares of stock, that's not a good scene, okay? But when you have 100 shares of stock, two short calls against, and a long call, now everything is covered. So he gets paid a credit and has no capital risk. Stock stays down, okay, he gets to keep his 40-cent credit. Stock goes up, he gets an even greater credit. If the stock goes way, way up, so what? He gets out at a silly profit. I mean, a great profit. Okay, so this is what happened with Mike. Mike had in his radioactive profit machine, he had $3.95 at risk, and then he collects $2.45. So guess what? That comes off of the cost basis of the stock. He's back to having unlimited upside, right? Because there's no short calls anymore. So he's back to having unlimited upside, but he can only lose $1.50. And you know what? After that, he did another income method and erased even more of his risk until he became bulletproof, where you can't lose any money. So, guys, gals, what do you think of that? What do you think of the income method that I shared with you? Okay? Taking a premium with an income method that poses no risk of its own, right? And then setting that against the cost basis of your stock, after it expires, you get to keep the premium. Hello. And you whittle away your cost basis until, guess what? Your net cost for your stock and your put is less than the strike price of your put. That's what we call bulletproof. It's kind of cool. Yeah. So we got a lot of folks participating. Guess what? You can vote in more than one category in this one. And I'm seeing a lot of folks posting questions, so let me get to them. Okay. Okay, Jill says, love it. Can't wait for my blueprint to arrive. Yippee. Jill ordered your blueprint when? When did you order it there, darling? Sunday. Okay, good. Well, you should see it pretty soon here. Should see it by the end of the week. Okay. Which income methods did he use? Asked Arnie. I'm not sure about his other income methods. I know that 5 is the first one that he used. That's a good question. What was the values of the limit order you said Mike placed to close those out? I believe that it was 15 cents, and then that's where he got filled to close the short calls. Good question. Oh, and Chris asks, why is he only selling one call option contract? Well, because that's all he owns, Chris. Chris is asking, why is he selling only one option contract? Why not two? You see, in order to put this in place, he sold 2 and bought 1. In order to close it, he's buying 2 and selling 1. Okay, so he's getting paid to put this play in place, and then he's getting paid to unwind it also. Okay. So great question. Okay, so let me go ahead and close. I forgot I had that poll up. Let me go ahead and close that poll. All right, so what's the winner? 45%, it's a tie. 45% said this one trade made it worth all the time I spent here today. Well, thank you. I mean, if you think about it, that's 110 extra dollars that that you would be able to have. Let's say $10 of it gets whittled away in commission. So it's 100 extra dollars. Those of you that do covered calls, how about an extra $100 for each covered call you do? And if you do it monthly, that's what, $1,200 a year? Did I just make your day? Did I just make your year? I hope so. And then the tie is, I want to know more about riskless spreads like this. Well, you're in luck because we have a number of riskless spread trades. Okay, and they can lead to this sort of situation where you have no risk and still unlimited upside potential. So income method number 5, what I just showed, is called a ratio call spread, but we call it income method number 5 in the context of owning stock in a put option and then applying the ratio call spread. Okay, so we call it by its common name, but we also call it by what it does. The nickname for income method number 5 is the money net, because it catches some on the front end, and it can. 5 different ways, by the way. There's 5 different ways to manage this. There's 5 different ways that it can pay you a second time. Okay. All right. So kind of cool. Within the context of your RPM, you generate credit, but there's no capital risk that would normally be associated with a ratio call spread. So I think you're going to dig it. Okay, so you apply the income methods to lower your risk or your cost basis or both. You may end up, I'm not going to say you always do, okay, but you may end up with a Mary put with all your time value paid for and your upside left intact. And we call that state of being bulletproof. Now, quick reminder, you might not get all this in the first viewing. That's why, number one, if you are a Blueprint owner, I say use your support. Right now, I'm coaching a fellow that today or tomorrow, he'll be unwinding his Disney income method number 5. He did a play on Disney. He happens to have income method number 5 and income method number 12 working simultaneously. Okay, so right now, I believe, depending on where DIS is today, if it's under 110 today, he'll get paid a second time if he unwinds it today. And if not, he can always wait until tomorrow. And if he doesn't unwind it, then there's other ways for him to get paid a second time. And so, guys, if you're thinking about doing these things, first of all, get the blueprint so you know what you're doing. And secondly, use your support so that you are certain that you know what you're doing. Okay, and it's support at radioactivetrading.com for guys like Jill, gals like Jill, ladies like Jill, okay, that have recently picked up their blueprint. Okay. All right. The income methods reduce the gap between what you have paid for your stock and your put and the strike price of the put. And when it finally goes the other direction, we have that phenomenon of bulletproofing. Okay. Now I'm going to ask one more question, maybe 2. Let's see. I've got 9 polls up here and we've only done 6. I don't think I'm going to do all the polls. But you know what? When I did this one, when I said, think about what I just showed you, if every loss that you took last year was reduced from whatever it was to 5% or less, would you do it? Would you like that? Okay. So that was one of those things. And everybody that answered said that they'd be better off. Okay. So I'm just going to ask, how much better off do you think you would be? Assuming that you had the same win-loss ratio last year, let's say you got into the same stocks. And let's even say that you didn't know the ratio call spread, income method number 5. All you knew was just the risk limiting characteristics. Would you be further ahead? Okay. Well, before 100% of you, 40% said this would have changed a losing year into 60% said this would have changed a losing year into a winning one, and 40% said this would have I did well last year, but would have done even better. Okay. All right. So let me leave that pull up for another 3 seconds, 2 seconds, 1 second, and close. Okay. And so 9% said, well, I didn't have any losses greater than 5%. I know there are a few Blueprint owners. Okay. But what about the rest of us? 45% say I would be ahead by $1,000 or more. Oh, really? Good. What if I ask you the same question next year? Right? Will you actually practice what I shared? That's the deal. Okay. Will you actually practice what I shared? Okay. 45% more said this would have made a difference of at least $5,000 last year. So what's the cost of not having this information? And by the way, that part I did give you free. Okay. Now the nuts and bolts of how to practice it, are in the blueprint, and I'd really like to get it to you. Okay. So what should you do next after this primer on limiting losses and bulletproofing stocks? Well, if it were me, I'd keep involved. I'd look back at your trading record and say, hey, would the radioactive profit machine change it? Same picks, same timing, but you had no losses greater than 5%. Most of you are saying, yeah, they'd change it. Yeah, they'd change it. Now, I'd like for you to, number two, consider how different things might be if you also took income. Did cover calls limit your upside? You know, on Tuesday, I shared an income method that does not involve short calls at all. It involves manipulating the put option that you already have, taking income because of it, but still having insurance. What? All right. Well, if you'd like to learn more about riskless spreads like this, I can point you out to the way to go. If covered calls limit your upside, would you like to not have your upside limited anymore? Were there any instances, for example, when you got called out of a stock that you thought to yourself, man, if I'd only just had the stock instead of selling a call against, I would have made more money. Well, it's that way with this. Okay, it's that way with this. So let's examine the value of the blueprint at radioactivetrading.com. Okay, some of you just said that the feature of never risking more than 5% would have meant 500 or more to you last year. Okay, well, many of you said 1,000 or 5,000. Do you expect to trade for another 10 years or more? Okay, so $500 times 10 years is $5,000. But the good news is I'm not going to charge you $5,000. Some others said that they had a $5,000 difference. They would have a $5,000 difference over last year's trading. But I'm not going to charge you $50,000. Okay? Not 50, not even 5,000. More like $600. Okay? It's $600 for our deluxe product, the home study kit. And even if you were really frugal, okay, and you wanted to just get the 12 income methods, plain vanilla, no fluff, no audio visual animations and so forth, no voice walking you through it, but just read a book, okay, you could get the blueprint. The blueprint is $339. Okay, so the blueprint is $339. The home study kit is $599, $600. Okay, and that's just an augmented blueprint. You've got the blueprint plus the augmented the audio visual discs. Okay, so here's the home study kit. Today, if you go to radioactivetrading.com/iridium, you will get the iridium bonuses. And I don't have time to really go through it here. We spent a lot of time on questions and even more time with me, John, about it and explaining income method 5. Okay, but there's a lot of great bonuses here that add up to several $100s of what would normally be charged. Okay, so there's that for the home study kit. It's $599, and what's kind of exciting about this, even the blueprint, if you pick up the blueprint at $339, it's a bargain. We've had so many people that have gone to those weekend covered calls trading seminars or credit spread seminars that they spent $3,500 on the weekend, right? And then they came back and they said, geez, we got 10 times the value out of the blueprint for 1/10 the cost. Gosh, I mean, think about it. There's 12 income methods. We're not a one-trick pony here. We're going to show you all kinds of different ways, all kinds of different conditions under which you can still make money. All right. So if you order the blueprint today, you get the RPM setups that ensure that you'll never lose more than 5% or less. You get 12 income methods that'll teach you how to take out premium or reduce risk or do both. And you get support, a second set of eyes. Now, I'm not going to tell you how to trade. I'm not going to say, hey, look, buy Starbucks as soon as it touches $50 a share. I'm not going to do that. But what I am going to do is, if you want to show me your trade that's put together according to the parameters in the blueprint, I'll let you know if it's radioactive or not. I'll let you know, hey, look, you have done a good job and you've kept your risk down to 4% or whatever it is. And what's your outlook? What do you think? And I'll just kind of be your sounding board. Okay. Support at radioactivetrading.com is a real service. And if you're a blueprint owner and it's the first time that you're putting something together, man, I want to be there for you. Now, for ongoing support, there's our Fusion subscription. And there's quite a bit more value to it that I can't even go into right now. But this is our starting point. The starting point is to have the blueprint. And most important thing I think to address here is if I'm going to talk about bulletproofing your stock, shouldn't I also have a bulletproof guarantee? Well, yeah. The thing is if you get this deal here, all right, where you spend $600 on the home study kit, all right. Well, if I'm wrong about it, you could lose $600. Okay, but what if I take all the risk? What if I was to say, well, shoot, I'll buy it back from you if you don't make or save because of your setup, either make because of the augmented returns of the income methods, or save because, hey, you got into that stock, but geez, good thing you had that put, right? Good thing you had that put exactly where I told you to put it. Put the put. All right. If I don't save you more than $600, hey, send her back. Send it back. But if I do save you or make you $300, $500, $600, and you can do that again and again and again over your next however many years of trading, would it be a good value? I think so. I think so. Most folks say yes. So if you don't love the blueprint, call us up, send us an email. We refund every penny. It's really simple. We get very few returns, but when we do, it's handled courteously and quickly. Think about what it will cost you not to have the blueprint. Would it be $500 to not have it? Last year, what was the difference that most of you said? Many of you said $1,000 difference. Some of you said $5,000. Think about how many years you might trade handicapped without this information. Okay. All right. So I'm going to take a couple more questions and then we'll just let her go here. Oh geez, we got piles of questions. Thank you. Steve. Hey, Steve. All right. Steve is a fellow that I've coached through some things. Steve says, Starbucks may be a very good trade with a Mary put and several income methods. I know it was a good trade at $4, which is more than my cost basis now. The blueprint is the bomb. Thank you, Kurt. Steve had a cost basis of like $12 a share, I think, on Starbucks, and he's reduced it by using the income methods. Very cool, Steve. I appreciate that little testimonial. And contact me soon. I wanted to talk to you about income methods 11 and 12. Okay. Before the split. I get it. Pre-split. Okay. Len says, is it easy to find a stock to do this with? What percent of the stock market can this work with? I'm not sure what percent of the stock market you can do this with. I will tell you that as a member of Fusion, you have access to a search engine that will find these kinds of stocks and give you, 12 or 15 picks a day. So there's no shortage of opportunities out there. There's more opportunities than there are trades. There's more opportunities for trades than you have dollars. Okay, so so if you're concerned, geez, is this a blue moon thing? Does this never happen? Jill says, I toiled over whether or not to invest in the blueprint, but the decision was easy with the 100% money back guarantee. Well, Jill, that's awesome, and I know that you haven't even received it yet. You placed your order on Sunday, so I'm looking forward. When it does come, send me an email at Kurt Frankenberg, Kurt F. at radioactivetrading.com. I'd just love to know and share that moment with you. Okay. Oh, goodness. We got other questions. Arnie says, I purchased the blueprint about 3 years ago. Are there addendums available? Yes, Arnie. There have been, I think, the addition of 2 income methods. I think 3 years ago we only had 10 income methods. So there's one that's in print and another that's in video format only so far, but we will be putting a print version out sometime later next year, or later this year, sorry. But you have access to it. Rick says, I have the blueprint and I am paper trading. Okay, so he's just gotten started. $2,200 up for the year on small stocks for a small account of $10,000. Okay, good. So Rick is just getting familiar with the concepts. He's just paper trading, but being up $2,200 is pretty good. Okay. Okie dokie, I'll email when it arrives. Steve says, trust me, you'll never give it back. Thanks, Steve, for that. Okay, folks, I'm going to close, but before I do, I'm going to just read this letter, okay? And if you think of the best question to ask me, send it to support@radioactivetrade.com if you think of a question afterwards. Here's a letter that I received from a fellow that was investing in growth stocks. He says, Dear Kurt, I've received the blueprint and I am a total believer in the methods. Thank you so much for sharing the idea of bulletproofing my stocks. In the last 6 months of trading, even though 6 out of 10 growth stocks cratered, I was able to manage all of them with absolutely no loss. And this has happened to me too, where I've been in, for example, General Mills. I was in General Mills, and the stock went down by 11%. Well, I made a 0.7% gain. Now, 0.7% gain is not something to write home about, okay? But the thing is, I bought stock, I bought a put option, and I did an income method. The stock went down by $11%. And so I ended up closing that whole deal at a small profit, and instead of an 11% loss. Okay, so which would you like, door number 1 or door number 2? 11% loss or small tiny profit. So that's what happened with him with 6 of 10 of these. He was able to manage all of them with absolutely no loss. And then he says, in some of them, I even made money. Okay, yes, like my General Mills trade. I wish I had known about bulletproofing a year ago. What is most heartwarming for me is that almost all of my portfolio is bulletproofed. Wow. Thank you again so much for the blueprint. That's Sudhakar Rajalu. And if you do a search on the Radioactive Trading blog, you'll see where he's interacted with our team quite a bit. Okay, Sudhakar is doing very well. So, folks, I'm going to go ahead and close it there. Again, if you have further questions, go ahead and send them to me at support@radioactivetrading.com. Oh, and you know what? A promise that I made at the beginning, I haven't fulfilled it yet. Let me do that. www.poweropt.com/RAT. I said that for those of you that did not already have a Power Options subscription, I would send you a link for 2 free weeks. So here it is. To send it to you in the chat box, it's a clickable link. www.powerup.com/RAT for 2 free weeks of Power Options. They're not going to ask for your credit card or anything like that. Okay. All right. And to pick up the blueprint, it's www.radioactivetrading.com/Iridium for the best deal. And I'm going to send that to you in a clickable form also for those of you that are live. So radioactivetrading.com/Iridium. Okay, very good. Folks, we'll see you out there. Pick up your guaranteed blueprints, and I'd love to hear about your success story on the next deal. Maybe you could be like Steve, telling me how your Starbucks cost basis is only $4 now. All right, we'll see you out there, folks, and happy trading. Bye for now.